Hey everyone, I'm David Finz, and on this episode of the Cyber Insurance Imperative, we're going to examine the state of the market, and more specifically, the state of relations between brokers and underwriters. Now, this past week, several hundred cyber insurance professionals met in New York at the annual Cyber Symposium hosted by PLUS, the Professional Liability Underwriting Society. And during the panels, representatives from some of the largest insurance brokers challenged the underwriters to justify the extent of the hard market in which we find ourselves for cyber coverage. And as any business which purchases cyber insurance will tell you, it's been one heck of a renewal cycle, with middle and high double-digit premium increases, higher retentions, sublimits on coverage for ransomware, and of course, a more rigorous submission process. Now, for the most part, brokers have been taking this message to their clients on behalf of our trading partners. We can't say that we're happy about it, but we recognize that times have changed. There's no doubt that the carriers have been paying out claims, particularly under cyber extortion coverage, and this sort of correction was inevitable, some would say even healthy for the market. Underwriters are right to be asking about the types of security controls their insureds have put into place. And as the losses mount, it has become clear to everyone that we're not going back to the days of two-page applications that ask about revenue and record count anytime soon. But this begs the question, what are the insureds getting in return for having more skin in the game? As I've been saying all along, there are two items that ought to be non-negotiable for brokers. One is the breadth of coverage. Cyber is an evolving risk, and the coverage needs to keep pace with the threat environment. One example of this is betterment costs. To cover damaged hardware with replacements of like quality isn't always feasible. Technology changes, and even if the version of the hardware that was bricked is still commercially available, we may simply be setting the insured up to get attacked once again. Now, if underwriters want to attach some sort of coinsurance to that enhancement, we can talk about that, but to not offer it altogether ignores the reality of the risk. The other is claims handling. As one of the speakers at Plus rightly noted, a hard market doesn't just impact underwriting, it spills over into the claims process as well. Lately, I've been seeing some resistance on the part of carriers to even considering non-panel vendors or extensions of time to file proofs of loss. I've seen carriers dig in their heels more about what forensics costs are reasonable and necessary, and even dispense with simple courtesies like advance copies of declinations or reservations of rights letters to the brokers. This needs to stop. We are supposed to be trading partners, not adversaries. The insured pays a premium for a policy, and when there's a claim, the policy needs to perform. Cyber claims have a lot of moving parts, and more often than not, it's the first time that the insured is reviewing their policy in depth. So let's work together to get to the right result for the insured. This is a symbiotic relationship we have, and keeping the marketplace for cyber insurance sustainable and relevant will enable our clients to find the more rewarding way to manage risk. Thanks for watching.